TGIF Warriors. Hi, Bran, Sinatra Jays. Yeah, I was just thinking the same. Did that Dixie turn? And NASDAQ did confirm on multiple time frames. So that usually happens during a parabolic move. And that was definitely parabolic. So we'll see. Actually, NASDAQ is a little lower. So what's being discussed here, and I'll bring the team in. Let's see. Hey, Kman. Do you think that this is, I think we needed 103.5 for some reason. I'm not sure what the reason was to confirm the low in the dollar. Do you think that this is just a pullback and we could get another big break? Jays is talking about, that we didn't complete. I know some other guys say, that we could still get one more flush under par. I don't know. Could it?
Well, I've been saying for a while now, I think we're still in broad ranges. There's been a lot to do about, of course, the debt ceiling, yields are pushing higher, dollar pushing higher, but I still think we're in broad ranges. I wouldn't be surprised actually that today we put in another spike in the dollar. It's correcting right now. Some currencies are quite resilient, especially Kiwi, for instance, or sterling.
Yeah.
But the euro is a bit less.
Yeah, it's a weak sister,
in my opinion. So it's
tough call. It's a tough call, isn't it?
We're in ranges, and that's the way I'm trading them as well. Okay. Let mine go now a little bit too early, but yesterday around fixing time we did very close to the lows in euro dollar, close to the lows in the cable, picked some up, but since I think we're in ranges, I've let them go, take the pips and enjoy the Friday watching the game, and that's still my view. And again, we are expecting on Sunday a meeting on the debt ceiling. The market is trading around it. The market is trading the positivity on the equity markets, the positivity of a resolution. The markets are trading higher yields because the US Treasury will need to issue $1 trillion worth of bonds, and that's what is driving the market now. But then we can wake up on a Monday and you only get like a small can kick, or they didn't agree on something, and then you have a completely different picture.
Yeah.
So yeah.
Well described. What we're
yeah.
trading, what kind of environment we're in.
Yeah, I keep my range, my global range, trading bias right now. There's no reason to sell dollars right now, but I don't think that there's too much reason to go and chase the dollar higher at whatever level right now.
Yeah, I guess you still have to say this 102 is going to be an important level, right?
Yeah.
That's
that's your pivot level around which things turn. And if you look at it, if you take that 102 then on the Dixie, but I'm going to repeat, I'm not watching the Dixie myself.
Oh, okay.
But if you look at it from a picture point of view, you below, you go down to 10060, right? That's 140 points. Above, you go up to what? 103s, 103.60. That's 160 points to the other side. If you don't break above that 103.60 or 104, what does that tell you? That tell you that we are in a range.
Yeah.
Right?
Deliver inflation target.
Yeah, that would be a pretty weak bear market rally when you look at it on a daily. And I know, guys, that's all they're looking for. If this is a lows, I think they're going to call it a flat Elliottians. If we just got back to here, that's still like a bearish consolidation.
Yeah. We could argue, though, if you look at that picture, that from April onwards, we're working on around the bottom there as well. No?
Too. Yeah, that's what I mean. It's so conflicted.
Yeah, exactly. The jury is out on that, and that I think is also reflective of what's happening in the markets now. We hit close to 111 on the euro. Now we hit on the medium-term support line around 107.70 ish. Bit of cloud action there as well, and we need something fresh, I think, to break it. Otherwise, we are going to continue to trade ranges. For now, this
Well,
is
for me, it's 109.40
Yeah.
is very key in euro.
That's going between
turned
level.
down.
That's probably your 102 on the Dixie as well.
Yeah, you're right.
And we're turning around those. Yeah.
I will say one thing, you know, the market certainly wasn't worried about dollar pressure. Commodities were, but not equities. So, you know, that old expression people are banning about, I forgot, I think it was Peter Brandt who said that if I get the dollar right, I get the whole market right. Well, the dollar, Blake pointed it out with the move in the yuan yesterday, that normally that would have put pressure. That would have put pressure on equities, and none of it did. It put pressure on gold and silver, copper, higher yields, part of that, but not the S&P. So
that shows you which way around the market is. It's a beautiful example. So this shows you that. Hey, good morning, by the way.
good morning.
It shows you that the market's short.
Put your tire iron away.
I know, man. It was.
All right, go ahead.
Anyway, so it shows you the market's been short equities, and now near the highs, I'm sure they got long metals, and you know, it's just when you get moves like this, you just see which way the market is, which way around it is, and I think it's beautiful because it allows you to potentially enter trades at good levels. You know, both you know, equities, metals, all of it. Then what have we been saying for days and weeks now? I've been saying, I would be very, very scared if I was short equities. And I was saying 4,200 is coming and probably stops above and then 43. And
see that blue line?
We're getting there. Yeah.
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 Okay. Well, I know a lot of patient bears. We've talked about it here on the show, that a lot of bears were waiting for the breakout over 4,200 that will be embraced. And then it gives it and the debt ceiling gives it enough juice. Maybe it's a buy the rumor, sell the fact on a deal getting done. I didn't think there was going to that one would get done. I'm still not sure, but that up there at 43 is also 61.8 back. 43, I don't know, 20, something like that. And we've had guests on that have talked about this level months ago, for completing something up there. Just something to be aware of.
Yep.
And then if we don't get there, Stel, and for some reason, all we've done is clean out the stops over 41.95, 41.85, and we start trading back under, say, 41.90, then you have to adjust the other way, that this was just a stop hunt and the market shook out the shorts. I'd say the job is done. I mean, when you say who's still short this, you know, I mean, who's still short? And then they, you know, took out 4,200 in the S&Ps.
DAX nearly at all-time highs, about 80,
DAX.
70 points away.
Yeah. In fact, I think one of the global markets that's not making new highs or is the Nifty. And we're going to have Rohit on today. Yep. And, you know, that's my opening question is why Nifty isn't participating. So, I mean, Nifty might be the best Bourse to short on the board. You know, just because you live in America or you live in Greece doesn't mean you can't short the Nifty. You don't have to live in the country to short that index, right? It's legal to short the world, right? So anyway,
I think S&P, if it breaks down back down below 4,200, then we see a daily close below. I think the range becomes once again 4,200 to 40, 50, 40, 60, wherever the low is, and you have to play that range.
Getting a decent bounce in silver today.
Not really convincing. No.
Gold. I still think we'll see 1920 that breakout line.
I agree. I agree.
And silver, you know, could rally, but to me 24.5 is necessary to reclaim it to resume the uptrend.
Exactly what I said on the flow show this morning as well.
Okay, and this measures 23, so we're not quite there yet. And there's a lot of confluence at 22.
Yeah,
Maybe we could see 22.
I like that.
Go on. Sorry.
Go ahead, Kay. Lost you.
I'm done still. Go ahead.
Okay. I just wanted to say one thing before I forget. Okay, something that I want your input on. So I've read a couple of pieces from people I actually respect a lot, and they both say if there is a debt deal, there's a deal on the debt ceiling and it gets raised, that's going to be removing liquidity from the market. Right. And that the rationale is that they're going to be issuing more debts and people will have to give their dollars to buy this debt.
Crowding out.
Yeah. So basically this, in the very, very short term, I agree. But I do mean in the very short term. In anything longer than a week or two, I don't see how this can be anything else than adding liquidity to the system. Because, and the argument was also, look at banks, they're in deep trouble now with more debt being issued, they have to buy more. No, they don't have to buy more debt. And it's like, it's making the assumption that however much debt the US wants to issue, it's all going to get sold at really great levels. No, at some point, they're going to start monetizing it again in a big way. So my view is if they raise the debt ceiling, which let's face it, 80 something times they've done it, they're going to do it one more. I'm guessing they're going to do it 50 more, but that's a different issue. They raise it. That means there's going to be a lot more dollar liquidity coming to the market if you look beyond a week or 2 or 3.
But it won't be coming into bonds because they're breaking down now this triangle and they're going to take out, and they're going to take the lows out.
So what happens when they one more thing? What happens when they take the lows out? Who comes in to buy bonds? It's not going to be China. It's not going to be Russia. It's going to be not going to be the Fed comes in. Exactly. Anyway, Blake, come on. Tell us.
I actually want to hear what Kman and Dale and what you guys have to say about your topic. Just Dale, don't let me forget. I have something to say about the bond market technicals. So just okay. Go ahead. Go ahead.
All right. So
Kman, let's hear what you have to say about what Steve just said, or what Stel just said.
The hell, dude.
Steve,
don't insult me. So go on.
I mean,
what?
Make up your mind. Steve, or is it the guy with the broken car? Well, I think there's going to be, and I'm looking at it a little bit on not on the opposite side, but what I said also on
range
is that I do think that indeed that issuing a lot of, I think it's $1 trillion worth or so, issuing bonds is going to have an impact. But the first reaction will be lower yields, I think, because of your second point. So and then afterwards, after a while, it's going to go in 3 waves. I think yields come off a little bit first, then they rise again, and then afterwards they are going to go back down. And that is around that will have a lot of similarities with what happened in 2013. But I think the impact is going to be spread over months, of course, threefold, if you wish. The immediate reaction, relief, and then you need less, how shall I say, insurance against bad news. So you will see CDS coming back in. You will see the short end coming back down because the people don't need to panic anymore. But then in the second wave, you will see the longer end, I think, going back up. And then after that, then we're coming into your scenario of yields likely coming back down. So
and if I may say one,
bullish to me, doesn't this 10-year yield chart? Forget what cover up the title, okay? Because we all have biases about where we think rates are going, and just look at the chart. And what would you do with the chart like this?
Looks like a bullish consolidation. You're right.
Okay, boom. All right.
I want to say one more thing before I pass it on back to you, Dale. My main worry with the argument about the debt ceiling is that the what these two people that I read, and I really respect them, I do, say that, oh, if the debt ceiling is raised, that's going to be removal of liquidity, so that's dollar positive. So basically, if we don't raise the debt ceiling and we go in default, is that dollar? Sorry, is that it's going to be dollar positive? Is that dollar negative then? Is it dollar positive?
Yeah.
Is it dollar negative? What is it? You know, it's a very difficult question. If the US does not raise
Sure,
the debt
there's no
ceiling
history on it. There's
and
no
and
history.
they default, does that mean there's going to be more liquidity in the system? I mean, it makes no sense. Anyway, I'm done. Sorry.
All right, well, that's the argument anyway. I mean, I read about the crowding out by, you know, in debt markets by the government for years. You know, they've been talking about that crowding out because of, you know, rates can go up, not because of great economic data, but simple oversupply and no demand. We could have a weak economy and higher rates because there's too much supply.
True. Absolutely true.
Okay, that's a different paradigm than what people are used to. Oh, yields are going up, the economy must be good. No, there's so much debt to finance, and so many buyers have walked away or have cut back on their buying that rates go up because there's no demand for all that supply. And I think that's what the 10-year weekly chart is saying. You know, anyway, I have a hard time thinking things are going to be benign. I'd have to see some real negative action. Actually, you know what? It could also be a descending triangle and we take out 330 and, you know, you're at 280. So, you know, but right now it's a guess, isn't it? Which way it's going to come
Yep.
out of here.
Yep.
So, okay, Blake. So, you know, we've covered a lot of interest rates. Love to hear what your charts are telling you. How are they talking to you right now about what's going on?
Well, first of all,
your charts talk. Come on, man.
Well, first of all, I want to say TGIF, everyone. It is this market's brutal. You know, you got the S&P and you know, the US equity markets are in breakout territory. It's broken higher. I think it's caught a lot of people off guard. You know, then you know, the volatility has been really low. So it's kind of like, when's this going to be over? But remember, it's options expiration today. And, you know, next week's going to be really interesting to see, you know, how the market kind of, you know, reasserts itself. You know, with that being said, I switched long, you know, to the dollar yen, you know, over the last 48 hours or whatever. And I was on the short side of these yen pairs. And I'm looking for them to rally now, and it's not because I'm, you know, it's not because I'm a super yen bear. I'm actually the opposite of that. I'm really looking for where to establish yen longs. That's what I ultimately want to do. And you know, we could, you know, talk about, you know, different levels, but you know, I'm really looking for like 142, something like that, to be, you know, on the short side of the dollar yen. So the reason why I'm telling you guys this is because, you know, I'm looking for certain things to happen before I decide to step in on the short side of, you know, the dollar yen. You know, a lot of them would be, you know, comments from, you know, maybe the Bank of Japan, but more importantly, it's you know, the correlation
Yields?
between the yen and yields is really quite strong. And then also I've got to mention that the Nikkei is right up against really key resistance here, you know, and by the way, that was me drawing yesterday, just kind of talking about it going up or down, and I just left my arrow there. So we are at really key resistance, right? And we're touching levels we haven't seen since 1990 right now. Now, and that's to be, you know, recognized, especially if you're out there trying to short dollar yen, which again, I'm not. I'm actually long this morning. So again, because we held 138, just in case you guys missed it. This is the breakout point. We held it. But I wanted to bring up this conversation because you were talking about yields. You guys were talking about how the bond market's going to react, and, you know, how the dollar is going to react following like a debt ceiling. I want to bring to your attention the 10-year. Now, Dale, you're an old school technician. What is it called when the 50 DMA crosses the 200 DMA to the upside. What's that called?
Golden cross.
Correct. So this is a golden cross right here in the 10-year in the 10-year bond market. Now, since we've crossed, guess what has happened? Just like every golden cross or death
I don't
cross
like
that you
those
see out there.
signals. Yeah.
I know it's not the best signal in the world.
Death cross
However,
either.
however,
I don't like them either.
However, for
Steve
Christ's
and I
sake,
don't like
people-
them.
For Christ's sake,
Just
people,
accept it.
let me finish what I'm saying.
We don't like them. Stop.
I don't give a shit. Shyster. Right. So anyway,
They're mean to
last time-
traders.
the last time we saw the death cross on in the 10-year. Now remember, the bond market has had a severe move lower. So, you know, I'm sitting here trying to figure out when yields are going to come back down. Remember the biggest argument out there that people have, and this is where the market has, is that at some point, now that the Fed's raised rates to, you know, where we're at right now, let's just say we end up with a terminal rate of 5.25. Okay, that the Fed's going to actually eventually, you know, start to lower rates at some point. Right. That's the argument. That would also argue that the 10-year and, you know, the 30-year and, you know, some of the lower end, you're going to start to see a move higher in bonds, lower in yields. So I'm not, and by the way, just so you guys all understand, I don't subscribe to that theory. I actually think the Fed's going to keep rates unchanged a lot longer, or at these levels a lot longer than the market expects. I think that's going to be the real reason why stocks actually end up coming down the second half of the year, is because the economy is going to slow and the Fed's going to say, tough. You know, who cares?
Yeah.
You know, the economy is slowing, inflation is still above 2%, so we're not going to be lowering rates anytime soon. I think that's going to be the messaging that hurts the market going into the second half of this year. However, that doesn't mean that the bond market's not going to take notice of that, or of an economic slowdown. And so, you know, when I'm sitting here looking at the bond market, I'm looking at yields, I see them coming down, and I see that me personally, I believe that this is going to be a lot of support down here in the 10-year. And I wouldn't be surprised if we, you know, bounce and sell off and do things like this over the course of the next, you know, couple months. But I wanted to point out that there's a damn golden cross, and it matters, you people. Steve, Dale.
Yeah.
Just kidding. No, but it's something that I've observed over the last couple of weeks, or the last week or so. And I
Personally, if you want my technical input, it's
not really. No,
I know you don't, but
it
was a rhetorical
even
question.
ask.
I didn't care about the answer. I think that all signals have some importance if you know how to interpret them, right? And what I mean by that is, as with RSI, you need to know when to pay attention to golden cross and death cross. So, for example, in this case, that we've had a very choppy, prolonged consolidation, any cross we see from the 50 to the 200, which literally can happen again. I mean, if we assume that we resume lower from here, we can see a death cross happening just a few weeks after a golden cross, right? So in general, when the two moving averages are more or less horizontal, because there is no trend like in this case, I completely disregard any cross that happens. Now, if there is a trending market, though, if there is a clear momentum in one direction or the other, then I think that there is validity to the signal of a death cross or a golden cross.
Again, and you got to think about it in the context of the way I'm trying to figure out what I want to do in the markets moving forward. And that's why, you know, if you take what I said earlier about what I think the Fed is going to do, how I think the market is going to interpret what the Fed is not going to be doing in the next few months, that is reason for me to believe that at some point we're going to see bonds bounce back, and we're going to see yields come down, even though I don't think the Fed's going to, you know, take cues from the market in this situation. And I'm also looking for an eventual short in the dollar yen, not today, but you know, maybe in the next couple of weeks, maybe in the next week, if we make it up towards the 140s and 140 yen or so. And that's why, you know, again, I would, if looking at the 10-year, I could give a shit less, Steve, that it is a golden cross, but it is factoring into my decision making based on what I believe is going to be happening in the next couple of months. And that's why it matters to me. And that's why I wanted to bring it up. So it's just something that I think we should talk about, and it should be talked about here, because if this does take place and you go and you do see the bond market, you know, you see the bond market bounce, and next thing you know, we're trading above 117, which we were just at like literally like a week and a half ago. If we're trading up here in the next week or two, you're going to hear people say, and there's a big golden cross, and you're going to say, oh, hey, I heard that on F.A.C.E a few weeks back. So, and that's the point. So let's talk about real quick, China, G7. You know, I was reading the G7 communique that you put in here, Kman, this morning. Here's the ForexAnalytix chat room for those of you that don't know it or haven't been here. If you go to the news and research room, you can see all the headlines that Kman put out, you know, from the Bloomberg terminal here on the G7 draft. It seems like everybody is, or the G7 is really kissing China's ass here, and that's just you know, me thinking out loud and speaking exactly what's on my mind. But it seems like they are really trying to play nice with China.
Oh, yeah, the thing is, we've evolved from the risk or the will to decouple from China to to a different stage, and they call it themselves de-risking, which means you don't want to shut China out, but you want to find some ways, as are already happening, if you look at the MEX and Taiwan and stuff, of being a bit less dependent on China. Just tell them that, hey, we are watching you, okay? But it's not as drastic as it was perhaps months ago or so, and when there was all these issues around the Taiwan Strait and everything else with Russia. So it's a little less drastic than it was, because quite a few countries have said, like, there's no way we can decouple from China. So, and that's,
well, you know what? Okay, a little history. The Japanese ambassadors were in Washington just a few days before Pearl Harbor. So, you know, I mean, what happens diplomatically and what could happen at times are two separate realities.
yeah. Mm-hmm.
Okay, so I'm just saying that, you know, that too could be theatrics. They want Taiwan.
Yeah, I mean, it's a lot of kind of trying to negotiate some peace, you know, around the whole Taiwan Straits area. So it's interesting. But you can see that the instant reaction from the US dollar CNH has been, you know, strengthening won this morning. So just a little bit of
that was a
Tom is saying, have you seen how big the Chinese Navy is now? And so, you know, so they're on the diplomatic scene, let's be friendlier to each other. And so, you know, it's like, watch what people do, not what they say.
Yeah,
don't buy the words. Don't buy the words, and don't do that in love either.
We have Canadian data in about 1 minute.
Anyway, that's the end of my
Canadian retail sales in 1 minute.
Canadian retail sales coming up. Let's go ahead and jump over there. And Kman, you were just going to say something real quick.
I interrupted him.
Yes,
no.
No, that was Steve talking to his son, but he wasn't muted.
Oh, okay. Well,
Crown
Canadian
Royal.
retail sales. Hey, just so you guys can see, we are stuck in this triangle right here in the dollar CAD. So any breakouts, you know, about 135, 135.35, break down below 134.30. I don't know if we're going to break just on retail sales today, but you never know. Did you see Foot Locker's earnings? And here's some of the comments they had to say. Nike's down. Wait, people aren't buying like $500 Nikes right now online?
They're buying
The-
Crown
all
Royal
these
Crazy.
all these
with a slice
collectibles.
of orange. Crown
Oh,
Royal.
so crazy that's happening. It's so weird. Weird that my 15-year-old son was bidding on $700 Nikes, and he's not doing that anymore. That's so weird.
Okay, a little bit better
Um,
than expected, but on core, in line
Yeah.
on the headline, whatever.
Right. Okay.
Yeah.
Yeah, nothing's gonna happen here.
What-
All right. Well,
what a dud to end the week.
it was a dud, but we have options expiration today. Real quick, before we pass it over to Dale with Rohit, Kman, any expectations for options expiration today?
Not really. There's a the FX options. There's a pretty big one, or just at 7 on the dollar China, but the rest is really not of any size of magneting anything at all. The one thing about China though is that PBOC said this morning that they would keep a close eye on what's happening to the yuan rate. So that was your secondary move lower in the dollar China, and we can't forget that. Powell and Bernanke have a bit of a powwow in 2.5 hours time. So
It's a panel discussion. So I'm assuming since it's a panel discussion, there's going to be something thrown around about monetary policy, right?
yeah,
You'd have to imagine.
Bernanke's there to make sure Powell doesn't talk like a hawk.
I think it's going to be an algo fest on any of his words, but we know Powell has mastered the class of walking fine lines. So to me, it's just going to be an algo battle somewhere.
Truth. Yeah. All right. Steve, Stelios, any idea, any thoughts about options expiration as we head into the weekend?
I think we probably squeeze higher in risk.
I
As
agree.
simple as that. As simple as that.
I
Well,
agree. The path of least resistance remains higher.
Options
one
are
of-
like relationships. 90% of them expire worthless.
Nice.
Here's I want you guys to just so you guys can see, like, in this is just some commentary that you're going to see in the ForexAnalytix chat room. Comments like this, for me this morning, and you're going to get them right here too. The S&P, I'm like, the problem I would have shorting the SPOOs is that A, it's broken out, B, it isn't pulling back at all. And so, I mean, if you're on the short side, you just got to look, like, I mean, we're breaking out, guys. I mean, I don't know how else to put it, while we're above 4190 in the S&P, which is only 20 some odd points away, volatility is low. The market's holding on to its gains.
Welsh called
And-
this.
What's that?
Jim Welsh called this whole scenario.
Oh, yeah, he's been saying it for weeks. And matter of fact, I'll be meeting with
4,300
him a little bit later today. Yeah, he's looking for
Yeah.
4,300, which, by the way, 4,300, just so you guys know, is the 127% extension of this move. That means the whole down move, the 38% retracement here. Or I'm sorry, that was a 38% retracement here. It's basically the previous range. It's 4,300. Also, the 618 retracement of the entire
43.12 to be exact.
Yeah.
Right. So it's
That's where
basically
everyone
that
wants to do it.
confluence looks like where we're going. So
And it's also the August 2022 high
right there.
at that area.
So
Yeah,
matter of
which
fact,
NASDAQ took
let's hear
that.
from your guest Rohit and see what he has to say about this breakout today. And it's nice to have him here, right, Dale?
Yeah, it's let's talk to someone who knows what he's talking about.
Hey,
Let's change.
that was a dig. That was like
Let's change.
That was like a public dig at Stelios.
At all of us.
Yeah.
Anyway, if you can't
All
laugh
right.
at yourself, there's a problem.
Have a
So,
great weekend, everyone.
All right, listen, team, I want to thank you guys for doing it again and again and again every week, keeping people alert, giving them very important critical technical levels for them to pay attention to, and putting your hearts into it, wanting to help people in our community get ahead and succeed. So kudos, I tip my hat to you, Blake and Steve and Stel, and Kman and everyone else who's supporting what our mission of edifying traders.
Thanks, Coach.
All right, so have a
Thank you,
great
Coach.
weekend.
Have a
Thank you,
great week.
Dale.
All right.
Enjoy
All
the
right,
interview.
guys. Okay, so Rohit, welcome back.
Hi,
How are
Dale.
you?
I'm good.
So how's the power situation there in Mumbai?
Perfect. It was a 2-day problem, just temporary, but
Okay,
resolved.
because you probably need air conditioning, right?
Yes, definitely.
Was it bad? Was it bad that day without power?
It's 33 degrees centigrade. I don't know how much that's in
Yeah.
Fahrenheit, but it's hot.
Yeah. All right. So, I was just commenting with all the global bourses really on fire, the Nifty hasn't made new highs, has it?
Yeah, the Nifty has been an odd boy. But
Wanna share the screen?
it had its moments, because when everything was down, when the chips were down, it actually made a new all-time high in December.
Why don't you share your charts, please, Rohit?
I'll do that.
Yeah.
So I have the
Because
presentation.
we're getting new recovery highs across the board, and this is the only one so far, right?
Right. So I have a presentation, but taking the discussion.
Okay.
So this is the chart. We did actually pretty well last year to December. So we made an all-time high
Right.
here. And
Right.
then from here, we started to deviate with the world market. So even as Asia and Europe started to recover in January, India just went into a limbo, partly because of there was this Adani scandal. Then there was the annual budget. But I think the scandal played a bigger role in dumping the sentiment. And then
What
from
was
there
the
on,
scandal with Modi?
no, not directly with him, but the Adani group has been closely associated with Modi. But there was a Hindenburg research report saying that they're not doing things right, which is still being investigated.
Okay.
But that caused the Adani stocks to fall 60-70% in 2-3 days, and that sort of rubbed
see.
off badly.
Okay. It was like your
But so
SPV.
since then, since Jan, India is sort of deviated from the world markets or Asia, and fell on its own, was not participating. But from March, which is also a seasonal period, usually we've seen like March 2020 was also a bottom. We've had previous seasonal bottoms in the month of March, so that was a very interesting period. We also had a huge short positioning, just like we have in the US. We had a max short positioning from domestic funds. Which also indicated that maybe we get a recovery rally, which is what we've had since the low in March. So April was good. May has also seen a recovery. I'm sensing it continues till at least the end of this month, early June. And then we watch out for the next set of resistance levels. So we have started to move up. I think I'm not ruling out we'll head towards all-time highs again, along with the global rally that is going on. So just to take it to the charts, what I've put together here. I think even one of my previous presentations, I said fear, and apparently after 6 or 8 months we speaking, fear is still high. Fear is pretty high on what will happen specifically with US, not in other markets. I think the fear is less in other markets, but everybody is pointing US banking sector, US debt ceiling, and that sort of has worry lines, and the fear that a recession may show up. And I've sort of fought that out with data points that I'll go over and charts, and so essentially focused more on the momentum and sentiment, and that I think has helped us navigate the course better than simply going with the narratives. Now, of course, positioning. So there are two things in positioning that show this fear. One is the largest short position in the bond market, which is a surprise, and it's remained prolonged. It's not yet caused a significant rally, but it's been prolonged. I sense we are close to ending. Starting a good move to the upside in the bond market, which means yields should start dropping soon. Not immediate, maybe in a week or two, we should start seeing that move develop. Okay, and the same thing,
they're going to squeeze all the record shorts.
Yeah.
Okay.
Because it's a second wave, we'll look at that chart. And similarly in the US equities also, we have huge short positioning. Indian short positions are pretty much cut out in this rally. This last 1.5 month rally, they are down to zero. But apparently in the US, they are adding shorts over the last 3 weeks. And it went to a new high first to the 2011 highs. Now you're, I think, close to highs seen only in 2008. So this is now become the highest in a decade.
Okay.
Now, is this really justified? So as I listen to a lot of the arguments which are around the potential that, well, this is how the cycle plays out, which means that things slow down. And when they slow down a lot, the Fed is forced to cut. And typically when they cut, the yield curve steepens, and that's when markets fall. Now, that's what happened in 2000. That's what happened in 2008. But I tried to make sense of this simply looking at the chart of the bond versus equity, and in a different time period, which means going all the way back to 1982, 84, when you had an inflationary crisis. My sense is that 2000 and 2008, why they are different is they were deflationary crisis
Right.
and not inflationary crisis, and which is why the reaction function of the bond and equity markets and their correlations were very, very different. So when we're looking here, I'm looking at the 10-year bond yield, and I'm looking at the S&P going all the way back. And the peak in yields, as we can see on this chart, I'll just use my drawing tools, is here. And after this peak in bond yields, probably a bit after or before this, had peaked in raising rates, what we have, the first wave down and the first pullback. I think till this point of time, equities were still falling. And then that is it. It was done. So basically, we can say once you are done with wave 2, pullback or retracement in the yields, then we were done with an equity market bottom. And after that, they were sort of inversely correlated. Yields going down, which means bonds going up. So in other words, bonds and equities were directly correlated. Bonds and equities rallied together. And that is very different from what we are anticipating right now. A lot of the positioning is anticipating that probably, and positioning is funny because it's actually anticipating the same. If you think bonds are short and equities are short, why shouldn't both rally together? This inflationary period suggests to me that that's what is the likely outcome. Both would go up together and not an inverse correlation like we saw in 2000 and 2008, which we can then
And
look
87, 87, that was a big deal too.
Yes,
okay,
yes, that's right here. But here, so we can see that here. This is the 1987 sell-off. Yes, there was a spike in yields, but yields went up, stocks went down, and then subsequent to that, yields continued lower and stocks continued higher.
Yeah.
So again, it was yields and stocks were inversely correlated. But when we come to 2008 or 2000, both these periods, what we have seen is the function was, well, rates were raised, because of overheating of the economy, and that eventually caused the market to roll over. And when the market rolled over, you're cutting rates till the point where, and this is the part where the Fed pivots is how it's being called out, that when it pivots, that the market still falls further because that's the recognition point that you're heading into a recession, and rates are being cut into that news flow. So this is how it's seen, that in both of these periods, rates went up, chasing as markets went up, rates continued to rise. And once again, they faltered and rates were being cut into the next recession. There was a pivot somewhere here where recession is recognized, rates are being cut, and markets continue to fall. The question is, will it follow this narrative or will it follow the inflationary setup? I am sensing it actually follows the inflationary setup, simply because what we've seen in the last 1.5 years has been a change in the model where rates are actually going up along with equities, and rates are actually going down along with equities. So we can actually see that in this period that the inversion happened somewhere at this point where markets are going down with rising rates. And so which is why I sense you could do what we did in 1982, which is once you get the second wave, you're getting that right now, you're getting this bounce retracement in bond yields. And once they're done with that and start heading down, which should happen once your core inflation data also starts to roll over, which looks imminent given that a large part of his rents and rents based on other stats, which is actual online stats, are actually showing a decline, meaning that the government data has only lagged. So just going by that theory, If this is eventually going to happen, it should drive markets higher. The only impending thing is probably the debt ceiling, which mostly gets resolved in the next 10 or 10 days or so.
Okay,
So
new
presuming
all-time
you're,
highs,
sorry,
new all-time highs you're looking for in S&Ps.
I am not ruling out that you'll see new all-time highs on the big picture, which means do I really end the fifth wave? So it's been a mental debate for quite some time, how to counter this entire move. Should we think that this is the end of this entire rally that started in 2009? Or do we still have one final move left? And I'm sensing that there is a possibility there's a final move left. And we've not broken this. This is, of course, the NASDAQ. We haven't broken this channel line temporarily, yes, but not strongly enough to say that it's reversed. The fall from the 2022 high to the bottom completely overlaps each other, which means it's not a 1, 2, 3, 4, 5 impulse, which I could say is A, then B, then C, but instead it's a complex correction, which therefore can get us wrong if we think of it as ABC. It can be W, X, Y, X, Z, which then completes one segment. And sometimes when you complete such a complex segment, it can end a bear market as well. There's also similarity with, maybe to some extent, with 2000, 2008 in a different sense, not the relationship with the bond market, but economic wise, I remember that the US economy did slow down a lot into 2001, 2003. The subsequent recovery was exactly not strong. The housing bubble, in fact, was known by 2005-06, and the market was still going higher. So you had a weak recovery where neither the NASDAQ went to a new all-time high. The S&P only did a double top in 2008. So you can have an environment in which markets recover into a weak recovery, and the recession, which is being anticipated, even if it gets postponed by 5 to 6 months or a year, gives us enough energy to squeeze shorts, and you only get the weakness later on when trouble shows up at some other point of time. So that allows us to complete this fifth wave in a recovery before we actually roll over. So it could go on for longer than most people are thinking, which is now beginning to show up in the charts. So there are two things I look at. One is, of course, my own momentum indicator. We've coined it the RMI, or the Rohit Momentum Indicator. It's essentially a weighted average rate of change that I've made in my own way. And it's crossed over to the bullish side on the monthly charts for the month of April. We are watching what happens in the month of May. So even though we have this bullish crossover, what is pending is that in the previous two bear markets, we also surpassed the 20-month average. So we are right now at the 20-month average. We are in the process of crossing it intra-month. I mean, we are above it now on the S&P 500 or the NASDAQ, but we want to see it stay there another 10 days to go. And if it does that, then I think that will be a secondary confirmation that we have started a recovery move. So then I have two ways of looking at this recovery. I could either think that, like I said, if it's a fifth wave, so I've tried to be open to ideas, either it's 1 and 2, or if I still argue that, okay, no, this is a bear market rally, I still want to mark it as A and B, then I can say C will have 3, 4, and 5 before it's over. And even in that case, it can almost get close to the previous highs.
Interesting. Okay. Even the bearish count is bullish.
Yeah.
Okay.
So a good channel.
Let me ask you this while you're on it,
Yes.
because, I talked to other Ellioticians.
Yeah.
And a few of them have been waiting for this 4,300 level to complete a wave before we wash out. Do you see that alternate count?
I actually do not, because by the time you reach 4,300, this advance will end up being 3 waves and not 5. And wave C should typically be 5 waves. So wave C is always 5 waves, in fact. So therefore, it wouldn't complete the structure in my mind. One can definitely argue, no, let's mark this as W, X, Y and complete it. But that would be forcing ourselves onto the market. So I think I won't take that as a conclusion. I'll really look for a clear impulse on the way down before I, call it reversed. The other thing is we also simultaneously watching not just the bond market, but we'll also be watching the dollar for the same risk environment, right? Is it rising or is it falling? and that
Well,
should also give us a clue at that point of time.
Yeah, 'cause the dollar's had about a decent week and a half bounce. It didn't bother the market at all. It bothered gold, it bothered commodities, but not equities.
Yes.
So you could continue.
So this is broadly the setup. Hedge funds positioned short on bonds and equities, which logically should mean that both rally. But the expectation is that bonds go up and equities go down. And we have listened to so many people say that if they're negative on the market, they might as well buy bonds, but sell maybe the Russell 2000. So two of the indices I was watching over the last couple of days was actually the Russell. And so before I come to Indian equities, I'll just show you that chart. This is, of course, the bond chart. So this is how I'm marking the count for the bond yields. I'm essentially looking at this being the first wave down, and we are doing a retracement. So somewhere either 61%, or best case scenario, we end up touching the top end of this channel before we start wave 3 down. That's what I'm thinking.
Okay. That's 3.9. That's a count I came up with a break over 360. It targeted 390, 395.
Right.
So you think we could go there before
it's
we
open?
start
It's
coming down?
definitely open right now till I get a reversal. Like the count here shows ABC, and it's ABC going on. As long as C is going on, I cannot preempt that it will reverse till it does.
Got it.
So, though on the other side, I am looking at the dollar index maybe completing something, possibly even today. So what I was watching for is a retracement of this fall. It could have gotten to 61% now. Intraday, we are already declining from here. What I'm looking at is ABC, where we also is looking at 5 waves. So this is A, B, and C is being 5, 1, 2, 3, 4, and 5. So this was the 5th. If it does remain down for the rest of the day, I'll presume that C is over, and possibly the bounce in the dollar index is complete, which means we could start the third wave down. Now, of course, it can spend some more time here before it does that. But what I'm looking for is 3 of 3 down in the big picture.
Do you have targets? 99, 98?
So let me just show you a big picture chart. Yeah, something like this. So looking at around 95, which to start with, which is the bottom end of this channel. Now, usually you would expect, I think if this is, I'm thinking that we've completed something inside this larger channel at the top side. So I think this is a major top here. This is possibly just the first wave bounce or consolidation. Once that is done, we'll be in the third wave, can test this, but possibly break this, eventually go back to 89 or 90 down here, closer to the X line.
Yeah. Got it.
Yeah, what I can't judge right now is how much time
that'll fuel risk. And does that mean we should be buying gold and silver on this pullback right here?
Absolutely. You should be buying gold and silver, emerging markets. Some of them have already given lead signals. Others probably do so in the days ahead. So if I look at silver, I think we have an expanded flat, which means A, B, and C, completing the second wave. Possibly do it today if the dollar is topping out, possibly get the reversal in silver. Need to watch. I'll leave it for tonight and see if it manages a positive closing. Then I'll start anticipating a third wave up. Now, it's third waves at multiple degrees, right? Because I think longer term, this is also a second wave. This is a 61% retracement of the entire rise that we saw in 2020. And from there, we've been trying to build into the third wave. So first, second, now it's 1 of 3, 2 of 3. So you've got 3 of 3, 4 of 3, 5 of 3. Should be a long way to go. Next move itself, I think 1-2 months should be around $28, $29. And then possibly that's your third and fourth, and then the third again.
Okay. This rally in US dollar yen, I would think that would have to peak to get that action in the metals? Do you think this move we recently had over 138, I mean, technically it still doesn't look bad.
Yeah, so it has some room. You're right. This is the USDJPY. I'm also taking this as a second wave, but wave C at a larger degree. So this is A, B, C. The C is not complete yet. The top end here could be as much as, what is this level?
42
Around
to
140, 41, 141 or 61% near 142.6.
Okay. All right. That's when yield should peak too,
Right.
up there, right? So
Yeah.
if we're going to have a big fall, if that's two, then a big break is coming.
Yes.
Okay.
So this is what I think follows, because in the big picture, so if you really look at it, you've
That
actually
ties in
done-
with yields going down, metals going up, and risk on.
yes.
All right, I'm getting your narrative now, buddy. All right.
So this is a really long-term chart. We're looking at 20 years of USDJPY. So this was a fourth, fifth, we bottomed here, and then we are doing some kind of a large A, B, B being a triangle.
Yeah.
Okay. And I'm presuming C is done. Now, of course, C is short. Some people can argue that, well, C didn't achieve equality to wave A.
Yeah.
But it did get to the fourth wave zone of the previous move, and that's sort of sufficient. What makes me also more confident of that is looking at the USD GBP, which is the British pound, because the GBP has touched this trend line of the highs, and all the moves prior to that are a series of three waves here, another three here, and similarly here. So I think we may have completed something big here, very long term. And that means it's,
so you think the high is in the pound? Is this
yes,
cable we're looking at?
yes.
So the 126, 127. So although we could see a new low in the dollar, we've already peaked in cable. It doesn't compute for me.
No, this is so this is the USD GBP. It's not the GBP USD.
Okay.
Yeah, it's the inverted chart.
Yeah, all right.
It will look like this.
I forgot to hold the mirror up. So anyway, okay, I got you now. All right. So big move coming in. Yeah. All right. So the sacrificial lamb to get really, that's a key. Do you believe this? And you're a wave guy and you look at a lot of instruments. If you get the dollar right, you get the whole board right.
Pretty much.
Okay.
That logic has worked at least for the last 20 years.
Oh, 20 years. That's pretty, that's long term. So,
yeah.
Okay.
Yeah.
All right.
So I was trying to show you the Russell just before I go to India.
yeah.
I was trying to show you the Russell and the US bank index, two important indices, because that's where all the trouble has been. This is the Dow Jones Bank Index.
Yeah.
Okay. This is one large ABC correction. One can even look at the KBW index, where actually you have equality between A and C. In this, in the Dow Jones Bank Index, C is a little shorter than A. But C looks complete because we have wave 1, 2, 3, 4, and I was just waiting for the fifth to be done. Last 2 days action makes it look like the fifth is done, because it's recovered pretty much above the low of wave 1. So I'm truncating the fifth here and thinking that the worst is probably over for the bank index, which means you're actually looking at the bank index giving you a good rally ahead.
You could get one more low for a 3 drive to a bottom. Is that possible still to have one more low? Even though it looks great. You see what you have labeled 3 in March, that's drive 1. Then you have drive 2 in May. But
if we form an ending diagonal, if we are forming an ending diagonal,
yeah,
which means something like this,
yeah,
that may be a possibility.
Yeah. Okay. Just wanted to know. Yeah, you call 3 drives ending diagonals. That's correct. Okay. And go ahead. I know I've.
And the second is the Russell. So the Russell 2000, which is the standard short for everyone who's sort of looking at US equities being bearish.
Yeah.
has made multiple bottoms at the same price range, I think, since June of last year. So once, twice, thrice, and this is the fourth time. So I was watching this very closely. Does it break this line? Or does it start recovering? Because if it starts recovering, then I can actually argue that this is a complex, W, X, Y, X kind of Z, something completing here in a very complex retracement. In fact, we may have even done, well, not 61, but 50%, a little more than 50% retracement.
And look what it held. If you go back there again, it held the pre-COVID high. Exactly.
Yes. Yes.
Right there. Look at that. Yeah. Okay.
So the last 2 days jump up, I think, is an early sign that it doesn't want to break down.
Yeah.
And that means this is all corrective. And in fact, this could be an ending diagonal over here. And we could have started 1, 2, and 3. So this is sort of a recovery starting here as well.
Okay.
So two of the weakest segments, once they start to turn, I think then you get a much more broad-based recovery in US equities. That was my main point. Now taking it back, so what have we been seeing in India? Now in India, sentiment again, this is the volume of puts traded relative to calls. And the reading we actually got in at the March bottom, this is the highest reading since 2008. So it's actually an all-time high reading because we have data only from 2012, 2002, once F&O futures and options trading in India became prevalent. So in all the data, this is the highest reading, which means maximum number of puts being traded relative to calls. And that to us is a sentiment extreme here that possibly the second wave, which I've been talking about, that we are in a wave 2. When we spoke a year back, the question was, will we get a deeper retracement in wave 2? Now with this sentiment extreme, it looks like instead of deep, this has become a consolidation, which is a complex correction, W, X, Y, I'm saying, and possibly complete. So I'm saying wave 2 is over, the consolidation phase is over, and we are probably ready now to start a larger degree move to the upside.
Okay.
The same is also seen in positioning. This is positioning by domestic institutions that were significantly long into the bottom in March based on this very same data. A lot of this data I'm showing, these charts come on a platform that we are building for data, which is being called Strike. Not yet live, not available to everyone yet. Should be in another week or two. So this is the chart of the Nifty.
Is it going to have all the Elliott labeling on it too?
No.
Okay.
Elliott labeling is hard work.
Right.
This will be more of a data analysis
Okay.
software.
Right.
So it will have a lot of the data which is available in India.
Okay.
That people can plot, maybe breadth, swing, various other things.
Okay.
So now this is the big picture scenario for the Nifty, which is that we are done with this complex consolidation. Complex patterns are typically seen in fourth waves, which is why I'm calling it a fourth, which means 1, 2, 3, 4. And we are going for the fifth, which means on a 1 to 2 year basis, if all else works, which is you get the weak dollar, you get the risk on. The fifth wave for the Nifty could be back to the top end of this channel, or best case scenario is where the fifth wave is almost equal to the previous wave. So we're looking at something at at least at around 35,000 on the Nifty, but a little long term. So you need to keep 1, 2 years ahead.
Good times ahead for stock investors in India.
Yes. In fact, I think the index itself doesn't reflect the kind of moves we're actually seeing in individual stocks because of the investments the government is making in the capital goods sector. So we have the capex cycle kicking in. You have a lot of manufacturing being done there because of certain incentives to produce in India. So manufacturing of electronic parts, etc., are all picking up
because people are diversifying their production from China to India, aren't they?
Yes.
Okay.
So all companies doing that, their stocks are doing exceedingly well, which is not completely reflected in the large cap index. Now, this is another angle to look at it. When I measure the quantitative cycle or the long wave in India, I do a Sensex to the CPI inflation ratio. Sensex is the other index for Indian stocks, just to get, and it has more history, which is why I use it. So we try and get an idea where we are in the cycle. So I say this is the spring, which was a huge long period, actually goes way back than the chart itself. And here it went through a long consolidation phase. I would call this the summer because it was associated with very high inflation and interest rates in India, which then dropped significantly after 2003, which is where the autumn starts. And so you had this big bull run. Subsequent to that, we've had an NPA problem, non-performing assets in certain sectors in the banking sector, which were cleaned out during this phase where it's underperformed relative to inflation. And from the COVID lows 2020, we are starting to see it beat inflation once again. So, which is a very good sign. So I think the previous phase of getting rid of the bad assets essentially and writing them off the balance sheets is over, and a much more cleaner bull run is being seen. And a lot of these sectors that were in trouble also are now beginning to participate. Everything from power, energy, capital goods, they were all underperforming the market between 2010 and 2020. And you're only doing well in defensives like FMCG, pharma, and technology. Now you're seeing a much more broad-based advance where everything is participating. So, which is where I think we are actually consolidating above the breakout point on inflation, and I think the next move continues.
Okay, what a great presentation as attendees.
So these are key levels. I think people who are little bearish will continue to watch and think, oh, is this still an ending diagonal? So they'll be watching 19,035 for a breakout. And if they're thinking that this is an expanded flat, A, B, then they'll possibly be watching 19,900, because a lot of people are still concerned because of the global cues. And so these are going to be two key levels which will help us get rid of those possibilities. And once we are past 19,900, I think then the bigger targets that I'm talking about will become more apparent.
Okay, Rohit. Well,
and this is a very, very short-term hourly setup of the Nifty, really drilling it down. We are looking at the first impulse from the March bottom. Right. So we had our first wave, second wave. The last few days, we saw the fourth wave pulling back till today. Today, the markets closed positive. It actually held the 20-day average and the lower end of the channel. So I'm sensing we start 5 up, which should head towards at least 18,700, 800. Or if it overshoots a bit, maybe touch the 19,000 mark, which we saw in the previous chart, that trend line of the highs, and possibly stop there for maybe some consolidation.
Well, you have your narrative has no fear, and definitely the acronym for fear is false evidence appearing real.
Wow, that is fantastic.
You can use it. So anyway, really great presentation, and I think it's the most bullish I've heard you since we've been talking.
Yes.
So dollar weakness, risk, there's nothing really to be short. Looking for bond rally, stock rally, metal rally, foreign currency rally, commodity rally, global bourse rally.
Yeah.
Okay. All right. Well, the glass is half full, and it's going to overflow, according to Rohit at India charts. And for you to stay on top of his work, follow him initially, and want to show your website, Rohit, before we call it a day?
Yeah. Yeah, so people can simply move over to indiacharts.com. We do a couple of things so far. I write content every day on most of these markets as they evolve. We continue to show the setups that we're really looking at under various segments. So people can simply click on whatever they want to see, whether it's the Nifty. So we have actually done a video update here. And if they actually want to, educate themselves about all of this, then I do a mentorship program, which is pretty extensive. Not a 1 day, 2 day session, but this runs for 3 months, 3 hours every Sunday. Somebody wants to learn from scratch how to look at charts, how to do Elliott wave analysis, and then how to actually execute a trade. generating the trade setups. That's kind of a comprehensive program that we do. And the third thing which we are working on, I did show screens of the software, which is going to be called Strike. It'll be on a different website, which will be basically data analytics.
Okay. All right, Rohit. Well, thank you so much for being flexible to adjust. First it was the power, then I double booked a day, and with the week we had in the market, really confirmation to people that are skeptical about what's going on right now. I needed it too. So again, thank you, my trading warrior brother. Good luck. I root for you, and let's get back together in this later in the summer, see how things are shaping up.
Surely. Thank you. Thank you so much for having me.
Okay, Rohit Srivastava, help me with your last name. It's
Srivastava. Yeah.
Srivastava.
Yes.
Okay, got it. And at India charts, easy to remember. Follow this man. Thank you, Rohit.
Thank you.
All right, buddy. Have a great weekend. Talk to you this summer. Good hunting. Okay, everyone enjoyed it, Rohit. Everyone that's still here, you join the team in 5 minutes for the morning edge. Have a great weekend. Don't just count your pips, count your blessings, and hope that we're adding value to what you're trying to accomplish by bringing in guys like Rohit. It's got to help. Adios. Oh yeah, don't just count your pips. What are you supposed to count? What are you going to count this weekend? Thank you, Tommy. See you guys. Thanks, Kevin.